Nobody tells you this, but there's a reason the most successful businesses maintain stability with their key people for decades while you're constantly replacing talent. Most business owners are stuck in the same cycle, throwing cash bonuses and salary bumps at their top employees, hoping it's enough to keep them from jumping ship. And then 6 months later, a competitor offers them 20,000 more and they're gone. You're left scrambling to replace someone who knew your business inside and out. Here's what wealthy business owners figured out that changed everything. You don't retain talent with cash, you retain them with contracts that build wealth. And one of the most powerful tools they use is something called split dollar life insurance. It's basically an invisible asset that makes your key employees unpoachable because walking away means leaving real money on the table. I'm going to show you exactly how this works and the two ways you can structure it so you can stop losing your best people and whoever's willing to pay a few $1,000s more. So let's break down what split dollar actually means in plain terms. The employer funds a life insurance policy for a key employee. The employee gets the death benefit and access to the cash value that builds up inside the policy. That's the basic structure. But here's where it gets interesting and why this works so much better than just handing out bonuses. Let's say you're planning to give your top salesman or your operations manager a $50,000 cash bonus at the end of the year. That's pretty standard for a lot of businesses. Instead of writing them a check for 50 grand, you take that same 50,000 and fund it into a permanent life insurance policy for them. Now, here's where the employers win. You get the exact same tax write-off as if you paid the cash bonus. The IRS treats it the same way for your deduction purposes. But now you also gain death benefit protection if that key employee passes away unexpectedly. Now the employee wins too. Instead of getting a one-time cash payment that either gets spent on a vacation or dumped into a savings account where it gets taxed away, they get a permanent life insurance policy that builds cash value over time and they can actually access and borrow against. It's not locked away until retirement like a 401k. They can use it for real estate deals, business opportunities, or just as a financial safety net. And they're getting life insurance on top of that, which they probably need anyway. This is the win-win structure that makes split dollar so powerful. The employer gets the tax deduction plus the death benefit protection. The employee gets wealth building plus life insurance coverage. And here's why this creates retention that cash bonuses never could. Your employer doesn't want to walk away from a wealth growing asset that requires you to be employed to keep building. Let's use that $50,000 annual example. If you fund 50 grand into a policy properly structured for 5 to 10 years, that employee now has real accessible cash that they can borrow against. Compare that to a $50,000 bonus that gets spent or taxed down to 35 after federal and state taxes. The bonus disappears. The employee keeps growing, and every year they stay with you. The asset gets more valuable. That's retention that you can't buy with salary alone. Now that you understand the basic structure, let's talk about the two primary ways that you can set this up. The choice between these two methods matters because it determines who controls the policy and how much access your employee actually has to the cash value. The two structures are called endorsement method and collateral assignment. Let's start with the endorsement method. Under this structure, the company owns the policy completely. You're the owner, you control everything. The employee is named as the beneficiary for the death benefit. So if they pass away, their family gets paid. But all the cash value, all the decisions about the policy stay with you as the employer. Here's the pro for you as a business owner. You maintain total control. If that employee leaves you after 3 years, you can recapture your investment because you own the policy. You can cash it out. You can keep it in force. You can transfer it to another key employee. It's your asset. This also makes it simpler to administer and track everything because it stays on your books and under your control. Now, the con, the employee has zero access to the cash value while they're employed. They can't borrow against it. They can't use it for anything. All they have is the promise that if they die, their family gets the death benefit. For some employees, especially top talent who think like an entrepreneur, this structure feels less attractive because they don't have any real control or access to the asset you're building for them. Now, let's look at the collateral assignment. This is the opposite approach. Under collateral assignment, the employee owns the policy from day one. It's in their name, they control it, but the company has what's called a collateral interest, which is basically a lien on the cash value for the premiums you've paid. Think of it like a mortgage. They own the house, but you have a claim on it until you pay back or the agreement ends. Now, here's what this means in practice. The employee can access the cash value above the company's interest. So, if you put in $200,000 in premiums over 5 years and the cash value is now $300,000, they can access that $100,000 difference. They can borrow against it, they can use it for investments, whatever they want. They feel true ownership of this asset and they can actually use it for infinite banking strategies or real estate deals while they're still working for you. The pro for you as an employer is this a way more attractive recruitment and retention tool. When you're using this to hire a CFO or top producer away from another company, telling them that they own a life insurance policy that you fund every year is a lot more compelling than telling them you'll own the policy with their name on the death benefit. High level talent wants asset ownership, not just benefits. Now, the con is you do have less control if the employee leaves early. If they leave after 2 years, you have a collateral assignment on that policy, but they own it. You'll need clear documentation of how collateral assignments get settled when they leave. It requires tighter legal agreements and more sophisticated planning. Now, here's the reality that both structures create: the golden handcuffs effect. This naturally creates retention because the policy value is tied to continued employment. If they leave, they either lose the policy entirely under endorsement method or they have to settle up the collateral interest under collateral assignments. Either way, walking away means giving up more or reducing a valuable asset. I want to frame this correctly because some people hear golden handcuffs and they think it sounds manipulative. It's not a trap, it's a byproduct. The handcuffs are a natural result of building a valuable asset that requires the employment relationship to keep growing. Yes, some employees may feel stuck in the company because they don't want to lose the policy benefits, but here's the reframe. This is exactly what allows you to keep top talent long term without consistently worrying about being poached by competitors. When a recruiter calls your key employee and offers them 20% more salary, they're not just thinking about the pay bump anymore. They're thinking about the $200,000 in cash value they built up in their policy that requires them to stay with you. That's a protection that you can't get with a 401k match or stock options. Competitors can't match because it requires long-term commitment and sophisticated planning that most businesses don't even know exists. So, how do you decide which structure fits your business? Start with your primary goal. Are you trying to maximize control and recapture ability, or are you trying to attract top talent who will think like entrepreneurs and want asset ownership? If your goal is maximum control and you want the ability to recapture your investment if someone leaves early, go with the endorsement method. You own the policy, you control everything, and you can redeploy that asset if the employee doesn't work out long term. If your goal is to attract top talent who want to feel like they're building wealth and not just collecting benefits, go with collateral assignment. Sophisticated executives and high-level producers prefer ownership. They want to be able to access that cash value and use it while they're still working for you. Your industry matters too. If you're in a high turnover industry where people might leave after 3-4 years, the endorsement method gives you more protection. You're not stuck with collateral interest in a policy owned by someone who's now working for your competitor. But if you're in an industry where key employees typically stay for 10 or 15 years and you're trying to lock in that long-term relationship, collateral assignment is more attractive to them because they get real ownership and access. Here's the thing both structures have in common. The employer gets the same tax write-off as if you paid a cash bonus. You're not losing any tax advantage by doing this instead of writing a check, but you retain death benefit protection on that key employee and you create retention that a cash bonus never could. Now, both methods require clear documentation. You need agreements that spell out exactly what happens at termination, at retirement, and at death. You can't just set this up and hope it works out. You need legal agreements that protect both parties and make the terms crystal clear. And here's something most business owners don't realize. You can use a different structure for different employees based on their role and the value to your company. Your CFO might get a collateral assignment because they're sophisticated and you want them to feel like an owner. Your operations manager might get an endorsement method because they're early in their career and you want more control. Let's be clear about who this is for. This isn't for every employee on your payroll. This is for 2 or 3 people who would cripple your business if they left tomorrow. The ones you can't replace easily. The ones who know your systems, your clients, your operations inside and out. You're building an asset on your balance sheet while creating loyalty that salary alone can't buy. So here's the core transformation. Stop competing on salary alone and start building wealth agreements that your competitors can't match. Now, this isn't something you'll set up yourself. You'll need proper structuring with someone who understands both the insurance and the business tax strategy because of the documentation and proper design structure. If you're a business owner who wants to see these policies structured for your specific situation, book a time on my calendar. Your competitors are still using bonuses. You'll be using contracts that build generational wealth.